Hi, I'm Vipul Mittal, and in this session, I will discuss what factors you should consider when you're doing a fraud risk assessment. So, you are the auditor and you're auditing the financial statements, and you have to obtain reasonable assurance that financial statements are free from material misstatement, whether caused by fraud or error. So, you have to be reasonably sure that financial statements do not contain any material misstatement due to fraud or error. So you have to be reasonably sure that financial statements do not contain a material misstatement due to fraud. And you identify and assess the risk of material misstatement due to fraud. You assess the risk. You do not prevent or detect. It is not your job to prevent or detect fraud. It is management responsibility to prevent and detect fraud. You may identify fraud, you may suspect a fraud, but it is not your job to prevent fraud, to detect fraud. Your job is to be reasonably sure, not absolutely sure, but reasonably sure that financial statements are free from material misstatement, whether due to fraud or error. So you assess what is the risk of material misstatement due to fraud. Here I am not discussing what special procedures you perform as part of risk assessment procedures to identify and assess the risk of material misstatement. I'm not discussing those special procedures that you perform as part of risk assessment procedures. But in this video, I will discuss those special factors that you must consider when you are doing fraud risk assessment. So when you are assessing the risk of material misstatement due to fraud, certain things you have to keep in mind. Let's discuss those. So you have to be mindful of the fact that there is a rebuttable presumption that risk of fraud exists in revenue recognition. So there is a rebuttable presumption that risk of fraud exists in revenue recognition. You have to assume that there is a risk of fraud in revenue recognition. And this risk of fraud in revenue recognition may be due to premature revenue recognition, recording fictitious revenue journal entries, shifting revenues, recording revenues when revenues have not happened, recording more sales, recording fictitious sales, recording next year sales as this year sales. And you presume this. You are the auditor. You have to make this presumption. This is what is stated in section 240 of the auditing standards. So when it comes to revenue recognition, you have to presume that risk of fraud exists. But this is a rebuttable presumption. That is, it can be proved wrong. You can go against this presumption. You are the auditor. Section 240 tells you to presume that risk of fraud exists in revenue recognition. But you can go against this also. You may conclude that no risk of material misstatement due to fraud exists regarding revenue recognition. You can presume that because this presumption is rebuttable, can be proved wrong, but you really have to justify and document that. That okay, because of all these reasons, I conclude that there is no risk of material misstatement due to fraud relating to revenue recognition. When you conclude that no risk of material misstatement due to fraud exists when it comes to revenue recognition, you should have reasons. You should be able to justify that, and you have to document all that. That what are the reasons that I conclude that no risk of material misstatement due to fraud related to revenue recognition exists. Now, when you are assessing risk of material misstatement due to fraud, you also have to consider that risk of fraud exists due to management override of controls. So there is a risk of fraud due to management override of controls. That management may override controls to do fraudulent financial reporting. Management may engage in certain unusual transactions to do fraudulent financial reporting. Management may engage in certain related party transaction but does not disclose those related party transactions. Management may place more emphasis on particular accounting treatment and ignore the economic substance of the transaction. So ignoring the substance of the transaction may favor a particular accounting treatment which is not appropriate. Management may establish weak controls over journal entries. Accounting estimates may be subject to management bias. So risk of fraud exists due to management override of controls. And you have to be careful to that. You have to maintain professional skepticism throughout the audit for instances of fraud. You have to be alert to the instances of fraud. And you have to consider risk of material misstatement due to fraud as significant risk. So this risk of material misstatement due to fraud is a significant risk. You have to consider this as significant risk and pay more attention to this risk. So students, you have to keep few things in mind when you are doing fraud risk assessment. So you have to presume that risk of fraud exists in revenue recognition, but this is a rebuttable presumption. You can even go against this presumption. You should be able to justify it and you have to document it. You have to keep in mind that risk of fraud exists due to management override of controls. You have to consider risk of material misstatement due to fraud as significant risk. All right, students, I hope this video is helpful. Watch more videos on fraud risk assessment. We'll connect again. Goodbye.